Thanks for joining us for our replay of the live Q&A that we just did on Facebook. We went over lots of different topics, so if you have any questions, try to get a hold of Tim or myself and enjoy this replay.
So I'm going to start with a scenario, okay? Billy Sammons, my esteemed colleague here, he comes to me and he says he wants to buy a $400,000 house, okay? We're using round numbers today. But if you want to buy a $400,000 house, and the question is, how much money do I need to make in order to qualify for that house, okay? Whether it be on my own or collectively with a spouse, boyfriend, girlfriend, anyone else that you might be going on the loan. Essentially, how much income do we need to qualify for that? So let's start with a $400,000 price, okay? And we're really talking, locally, Calvert County, Tri-County area, $400K, okay? Let's say you're doing a conventional loan with 5% down. Now, a $400,000 clip is in that wheelhouse where USDA might be an option, and it's something that we've talked about a lot, where USDA is a no money down product, and it's really popular here. We've done so many of them in our career, so that may be an option for you if you make less than $138,000, $138,300 actually in Calvert County, and you're a house of 1 through 4 people. You can actually qualify for no money down. But for this example, 5% down. That 5% down is $20,000, okay? 20K. So you say, Tim, I have $20,000 saved. I'm willing to put that down. That means you have a loan amount of $380,000. So I'm borrowing to buy a $400,000 house. I'm borrowing $380,000. I'm putting $20,000 down, okay? That monthly payment, roughly, is going to be about $3,000 a month. Now, what's included in that $3,000? We call that PITI, principal, interest, taxes, and insurance. That means your principal and interest, paying back that $380,000 over 30 years, taxes and insurance, your property taxes and your homeowner's insurance, okay? So we have a $3,000 a month mortgage payment. Let's assume that you have $800 a month in other debts. A car note maybe, student loans, credit cards, okay? So $800 a month, meaning your total debt after you buy this house per month is $3,800. The rule of thumb for most programs is that you can borrow to the point where your debt to income ratio is 45%. And what does that mean? It means 45% of your gross income every month is going towards this $3,800. So reverse engineer that number. $3,800 divided by 0.45, that's how you come up with that 45% debt ratio. That means you would have to make, collectively, all the borrowers on the loan, $84.44 a month times 12. It's roughly 101. I think I did the math earlier. It's 101,333. There you go. To buy a $400,000 house in Calvert County with 5% down, or perhaps with no money down, USDA, you need to make roughly $101,000. Now that could be split amongst two spouses, husband and wife, boyfriend, girlfriend, whatever works, and compile that income to qualify together. Or if you're a single individual that makes basically a little over 6 figures, you can qualify for a $400,000 house. This is based off of a very round number, 7% interest rate. This $3,000 a month. What we're finding lately is that rates are sputtering. We're hoping that they improve. But if you're somebody that says, I can swing $3,000 a month, I make the $100K, now's the time to make that purchase, because as soon as 7% goes to 5%, that $400,000 house is now $450,000. So the increase in price, lower interest rates, the payment could be a net, no change essentially. But as soon as that 7% goes to 5%, that $400,000 goes to $450,000 because there's more competition. So to summarize, a $400,000 house, roughly, you're talking, $101,000 a year to make that. Billy, any thoughts? Any questions?
That's good. So
Okay.
when people come into your room, they sit down with you.
Mm-hmm.
Where do you start?
So where do we start? We kind of start with the affordability piece. I would take away this 400. I would take away that 380. I would take away this, and I would say, how much money do you have? Okay, I have 20K. How much do you want to spend per month? $3,000 a month, okay. And then we reverse engineer the preferred payment to figure out what sales price correlates with the payment that they're seeking. However, I will say, sometimes I'm having to recalibrate the expectation for the payment because somebody comes in going, you know, I need 4 bedrooms, but I want my payment to be $1,500 a month. There is a moment in these consultations where I'm trying to let my client become a little bit more realistic with what they're seeking in a home buy and a home purchase. So if they're saying, okay, I think I could stomach a $3,000 a month payment, I have 20K, this scenario would probably just kind of fill itself in. It is easier if you're someone that's been paying rent, because you know, if I've been paying $3,000 a month in rent, I know if that's a comfortable number, if I can expand or if I need to contract. Because if you're $3,000 a month rent and you've been saving, you could probably go to 32, 33, 3,500. If you're $3,000 a month and you have not a dime to your name because you're really scraping by, well, we need to seek a $2,800 or $2,500 mortgage payment. So that's where I normally start off. It's how much do you have? How much are you willing to spend? And then we get into the nuts and bolts of the credit scores and how much money do you make and things of that sort. If I have a client that is credit challenged, a lot of times they know they're credit challenged. They come in, they kind of lead with that. They say, hey, I'm not sure if my credit's very good. So sometimes in that scenario, I'll start with the credit piece. And it's something that we do a lot of. We do a lot of helping advise with the credit to see if we can get an improvement over the next 3, 6, 9 months without you having to go to a credit repair company. Now, we do have that for the severe instances where we probably need to put you into a program. But if you're somebody that has credit concerns, you don't have credit, you need to build credit, you don't know what your credit is, sometimes that's, you know, step 1 or 2 after we talk about this other stuff. But it's really leading questions. You know, I ask leading questions. What are you looking to get out of this? Why are you talking to me? Why are you talking to Billy? And it just kind of fills itself in. And I will say, I just had a consult in my office today. We are here in First Home Dunkirk. Come to the office. I love it. I love meeting you. Come to the office, sit down, let's talk about it. And the consultation tends to be fairly enjoyable. It's a good conversation to have. So I'm not the... Let's not do everything all virtual, although this is virtual. I like to be in person. It's great.
Yeah.
Yeah. So yes, that's step 1 for me. And then it's kind of finding out what programs are available in the areas that you want to buy in. That's the next part of the conversation. I talk about USDA a lot. I mentioned it in my calculation. I did the calculation for a conventional loan, but if you're looking in Southern Maryland, USDA may be a part of the conversation, and then we're talking about, hey, just make sure you stay within these parameters if you want to seek that financing. The areas can also dictate some other little nuances, like, you know, property taxes, HOAs, what types of properties are you looking at. So as a first-time home buyer, these are things that you probably never thought of, that North Beach proper has a town tax. You probably didn't know that. You probably didn't know that, you know, maybe a condo could have a fairly large monthly HOA fee that's going to take, you see the listing and you're going, oh man, I can get a condo for $280. You didn't realize it's $250 a month for condo dues. So little things like that I try to educate my clients on. The PMI question, I see that on the sheet. So one of the questions that we got is, how do I avoid PMI? Avoiding PMI really becomes the conversation of 20% down. That's your key marker where you don't need PMI. 20% down or 80% loan to value. However, if you put money down 10 or 15%, you can get rid of monthly PMI. There's different ways to do it, but that 20% marker is the number that allows you to not need the PMI. And some people are just so against PMI, but again, it's a conversation of, do you want to part ways with that much savings? If the answer is no, then you might have to bite off that monthly bullet of PMI. It's just kind of a necessary evil. It's a pay now or later conversation. That tends to come from conversations with family members where they say, "Are you paying PMI? You shouldn't pay PMI." Well, there are parameters that kind of require it.
And you get back out. You can get rid of it.
You can get rid of it. Yeah, you get into a conventional loan, you put 5, 10, 15% down, whatever. You have a mark on your amortization schedule where the PMI automatically drops off. And then if your home appreciates, which we are running at a very consistent clip of appreciation, 5, 6% annually, eventually you'll get there sooner than you expected. If you do work to the house and it appreciates, you'll get there sooner than expected. You can have it dropped off. You can apply to have it removed. We had a client recently that sold a house or bought a house with us, and he said, very simply, I asked him, what's one thing that you would want first-time homebuyers to know? He said very simply, ask questions. That's very explicitly, just ask questions. It sounds so simple, but the worst thing I think you can do is to try to do your own research on the internet. He even said this. He said, I researched programs and was reading articles and things of that sort, and things were simplified when I started asking Billy and Tim questions to the nth degree. He said, I just wish I had done that sooner. And secondly, he needed to be a little bit more realistic for when he was ready. He tried a year ago. He was stretching himself thin. He gave it 12 months with a lease, and 12 months later, he was in such a better position to buy a house. He was ready. He could pay his own closing costs. He made a great offer, and he closed on it. So you get that excitement, but also be realistic as to whether or not you're ready now, or if you need to give yourself 6 or 12 months. Go into a lease or live with family a little bit longer. So those were his 2 items of advice. Ask questions and really be true to yourself as to whether or not you're ready. Billy.
Yeah, ready to go?
Yeah.
We'll pass off?
When you're...
Oh.
Well, no, come on up here with me.
So you didn't show how
Billy Sammons, everybody. Billy Sammons.
Yep. Type difference.
When you're talking to buyers, now we created a buyer... Or you created a buyer video series.
Yep.
Kyle said that was awesome. He said
I've never had anybody complain about it. It's a 10-part video series that actually you're in part of as well. Mm-hmm. And we take it step by step and we offer it for free.
Yes.
Even if you use another agent, I've still offered it for free. And I've actually had that happen a few times where they learned enough from our videos but still use their friend or their aunt or whoever.
Yes. So
it happens. It's all right.
He took the time to make that. To sit down and watch, I think it's great. But when you talk to a buyer, what's the first thing that you...
So I'm the opposite. As you say you love to be in the office. I love to not be in the office. I don't like being in the office at all. As a matter of fact, when you say, hey, I'm thinking about doing it, usually either you talk to Tim or I first. Like, it happens either way. It's kind of inverse. Mm-hmm. But I usually go to a house first, right? So if you're like, hey, I think I can be in this price range, let's go take a look. And as we walk through the house, I like to point out some stuff like, where would you put your TVs, and where's your couch going to go, and what do you like about this? And I start getting feedback from people right away. Mm-hmm. And as we do that, they're looking at colors, they're looking at updates. I'm looking at, how's that water heater, and how's that HVAC sound, and are there any spots on the ceiling? Like, our set of eyes are totally different. And that's what it's supposed to be, right? I'm supposed to be looking at what problems am I going to have to work with, and they're looking at how aesthetically pleasing it is. So we look at different things.
So that's your value proposition.
Yep.
Is I've seen, let's put a number on it. Do you think you've seen 3,000 houses? I don't know. How could you even know?
I don't know.
But you've seen so many houses in your career that you can locate the potential issues or the potential
stuff like that,
costly items ahead of time. That's your value proposition.
Yeah, plus we flip houses. So we've seen a little bit of everything.
Yeah, right.
Yeah. So that's our first step. So once we get in there and we look at a house or so, and if you've talked to Tim, great. Then what we do is we set you up with a search. If you haven't talked to Tim, I send you off to Tim, and we start that search right up, right? And the search program we use is amazing because we set your criteria, what you're looking for, beds, bathrooms, locations, all that stuff. But it actually starts learning your behaviors, right? So if you start clicking on stuff out of your range or out of your area, it might start sending you a couple that may or may not be what you think you want. Because the number of times we've had buyers that like, I know I want this, and then you know what, that house over there, and you send it to them, and that ends up being the one. And this program finds it for you. It's really nice. And
I
so,
didn't know that existed.
yeah,
Wow.
it's pretty cool.
Interesting.
Yeah, so it starts finding things that may or may not work for you. And as you start finding the houses that you like, you know, you just send them back to me and you say, hey, I want to look at these 3, these 4, these 2. And I set up those. If it's 7, 8, 10, it's a little more arduous, right? And I'll map it all out and we'll get up a plan and we'll go look at the homes.
Yeah.
Once you find ones you like, then we send you back to Tim because Tim should run numbers, right? You can do net sheets and things, right?
Yes. So that I actually had a colleague back in the day that used to say, you wouldn't go Christmas shopping without knowing what's in your bank account, or
Well,
these days how much you have left over in your credit
My
card.
wife does,
Anyway,
but that's fine.
so before you go shopping, you need to know what your capabilities
Yeah.
are. So again, you may show a house or two, get sort of the temperature of the client, but eventually it's that turnover back to someone like myself
Yep.
where it says, do you have the capacity to do this? So that's just that black and white, do you qualify?
Yeah.
But it's deeper than that. It's do you qualify comfortably? Here's the payment, is that what you are looking for? So sometimes there's some calibration between the two of us where you say, I just showed this property, they love it, and I say, Billy, this is not what we discussed. And so, you know, that's that back and forth relationship in that conversation, but you have to know what your capacity is to borrow and what the numbers would look like.
And sometimes it happens the other way too. They find something that might be a little bit smaller than but they just love it and they love the land or they love whatever, and so now they can do conventional now because it's or maybe they push the budget and now they have to bump up to like an FHA. Sometimes they'll find something that needs a ton of work and now we have to do a 203 and we have to switch it up a little bit. Like all these scenarios happen. So that's a big part of it too. Maybe they're approved as a conventional, but we end up going FHA just because of the mix and match of things. So
yeah.
So then you're out, you're looking at houses, we send you back to Tim, we make sure the numbers work, and then it's a time for me to do paperwork. We use the Sky Slope program, which is really easy. You click and you go. But at the same time, a lot of first-time buyers, I'll get on the phone with them or sit down with them as we go through it, make sure I answer all the questions. I even sometimes will send it as a PDF first that's not clickable, because when you click, it just screams you to the next one and screams you to the next one. So sometimes I'll send it as a PDF, and if you do it that way and you look through and you highlight and you make your comments, then when it's time to have the conversation, and then we can sign. It's whatever your comfort level is. The person you were referencing before, he was very articulate, and he read right through it. He knew what he was looking at. Like, he was very good. It cruised right along. But sometimes you've never done this before. You've got questions, right?
Can I go in a different direction?
Yeah, sure.
Let's talk about somebody that needs to sell a house.
Okay.
And is going to buy one. Okay, so we kind of throw out this idea of first-time homebuyers all the time. And okay, yes, maybe something like this is technically geared towards somebody like that. However, I just spoke to somebody this afternoon, right before you got here. That was a consultation with somebody that had already bought a house before.
Yeah.
But it was 4 years ago. It was in the height of COVID. And the amount of things that they either forgot or needed refreshed, or it was almost like a brand new consultation.
Oh, yeah, we go over that a lot too.
Yeah, so we're not discounting the fact that when you're going to sell a house and buy another one, that we shouldn't put any less amount of service into somebody like that.
I mean, if you did a thing once every 5 years, I mean,
right.
Plus everything changes.
Like me working out once every 5 years.
Well, that plus the paperwork 5 years ago is different than it is now. They updated forms back in October, so it happens all the time. But some things that are always going to be true is we always have our inspection addendum in there. I know in the height of the market, people are waiving inspections and doing as is. If that, I just can't. I can't with good conscience do anything like that. We can do like an as is with the right to inspect still, but I'm not waiving inspections. That's just not something you and I really advise. Unless it's a very experienced person who's done this a bunch or has cash and flips houses or whatever the case may be, but that's like a 1% situation.
Yeah.
So we have the inspections in there. They give you between 5 to 7 days to do those inspections. We have a few inspectors that we use that are trusted, right? And it'll depend on the house itself. You have to do the home and structural. He'll go through, he'll test, make sure everything's working, turn on washers, dryers, plug stuff in, all the roof and all of that stuff. If you have a well, he'll take a water sample if you want to, depending on your kind of loan. He'll test the septic, which I don't care what kind of loan you have. We're doing that septic inspection because it's expensive, but let's do it.
In this county, with the amount of septic issues we've had, I definitely suggest doing a full septic.
I've been through septic stuff. So if it comes up, don't panic. Like I've been through, I think last year alone, 8 replaced septics. Like it's a thing. we do it. And then you end up with a new septic after some negotiating, going back to the table and figuring it out, because those sellers, I mean, have to have a septic to sell the house. So you got to play ball and figure it out. But
Correct.
Yeah. So you have the general home, you have the water, the septic, termite, and that's usually required. And have somebody come through, just make sure you don't have any termites in the house. And then you can actually do radon too. That's if you have a basement and you're in certain parts of the county, people will do radon. And then we always rate our offers that if the home inspector finds something out of his usual expertise, that we have another few days to bring in an expert, like structural, like if there's cracks in something, mold.
Yeah.
Those things are always covered, and we have that in our addendums as well. So those are always ways, and people ask us all the time, can I get out if I find something? Yes, with it, as long as we're meeting our timelines and our deadlines, then yes, you can still get out and still get your deposit back, as long as we've all followed the criteria in the contract. So that's
the word
huge.
deadlines kind of triggered me to mention this same client again, where you're going to be asked a lot of different things. Asked for requests for documentation and to sign this and to sign that. You basically have a real estate contract and you have a loan contract, our disclosure package. So you're signing him, you're signing with me, you're giving me pay stubs and W-2s and bank statements, and you're sending an earnest money deposit with Billy. All these things, all these requests. My biggest advice, and it's very simple, is just to be somebody that's religious about checking emails, checking your phone, checking your text, because it's an evolution throughout the process where we're asking for stuff. We've all had that client that is either bad at checking their email, or they work in like a secure building where they can't have their phone.
That happens a lot.
So it happens, but that's actually something that client mentioned, is just to just be ready to produce a lot of items for us.
What are some of the comments? I have it in my packet, by the way. The buyer's packet, you'll have it. It's got it in there. But
so I say the Mount Rushmore of financial documents.
There you go.
Bank statements, pay stubs, W-2s, tax returns. There are a lot of instances where we don't need tax returns. So really it's just pay stubs, bank statements, W-2s. I would throw a credit report in there too, but that's something you produce. It's something that we pull on our end. But there's 3 avenues for qualifying, okay? I'm going to whiteboard this one more time if you don't mind, okay?
Yeah.
All right. So we have, these are the 3 things that we're qualifying you on. We're qualifying you on credit, income, and assets. 1, 2, 3. Those are the 3 keys. Okay, so credit, that's your barrier to entry. What is my history of paying my bills? So I've had conversations with clients where they go, I hate credit scores, I hate credit, I don't use credit cards, I think it's stupid. Well, it's the only real measure that we have, okay? So credit score, what are your credits, but really that also allows us to see what your debts are. Income, do I have the capacity,
That's a big part.
right, to actually make this mortgage payment? Ability.
It's income and debt.
Well, true. Yes, these are related with each other. The debts and the income, and then the new mortgage, they kind of have that relationship where we calculate the DTI or debt to income ratios. So income. Do I have the ability to repay? That's a CFPB term. Do I have the ability to repay this mortgage? And then assets. Do I have the money in the bank to put money down if needed? Pay my own closing costs. But a step further, do I have some in reserve? I had a client that she filled out an application a few days ago. Everything was good, except she had basically the amount of what her new mortgage payment would be. That's how much she had in the bank.
Yeah.
And I said, first of all, I'm not sure that's going to work anyways, but even on a personal level, would you want to move into a house where you have the exact amount in your bank account as what your first mortgage payment is going to be? That's a dangerous thing, and it's not really something a lot of times we can get approved anyways.
Yeah.
So it's credit, it's income, it's assets. Do I have the ability to, do I have the history that I pay my bills? Do I have the ability to pay it? And do I have the assets to support it? Ideally reserves. Because again, if you buy a house,
you should have the money to do it.
You should have the money to do it, but you should also have the contingency plan. If I was out of work for a month or 2 or 3, how would I make my mortgage payment?
Yep.
So those are the 3. There used to be a 3 C's. I'm trying to remember what it was: credit, capacity, and something. But I like this. Just
Cash.
credit. Maybe credit capacity, cash, yeah.
Yeah.
But anyways, that's what we look at. That's kind of our flow
Gotcha.
chart.
All right, so if you're keeping score at home and you're taking your notes, all right, first you sit down, we look at a house, kind of come up with an idea, kind of have a budget, we look at it in person. We send you to Tim, or you start with Tim, right? And then after you get that numbers rolling, get some ideas, pre-approval, then we go out and start looking at houses, right? Once you've seen enough houses that you can pull the trigger and like the one that is going to be your next home, we write up the contract, we negotiate it out, get it accepted, and then you get into home inspections. And that's where we're at.
Yeah.
So once the home inspections happen, we also have to negotiate any repairs and things of that nature too. That's usually on the table. And as that's happening, you're ordering appraisals.
Yes. So that's our window. Those are our sort of. We don't go to the property like you do.
No.
And
so you have a party. If you have a housewarming party, make sure you invite Tim.
Oh, that was the other C. Credit capacity, cash, collateral. Collateral is.
How did a house party get you to collateral? How was that?
I don't know, man. I don't know how this brain works. So the collateral for the loan, we're lending you. My example earlier was $380,000.
Yeah.
We're lending you this money. The collateral for that loan is the property. Is it in good enough shape for us to lend the money?
There it is. That's how that came about.
Yes. There we go.
So people always ask, do I have to set up the appraisal? What has to happen for it? So you order it on your own.
Mm-hmm.
You can't choose. It's illegal to choose the appraiser thanks to the market crash of '09. Now the list, and you just make the order. Mm-hmm. Someone's randomly selected.
Yep.
They go out to the home. They pull up all the comparables, and they get an idea of the value. They also check to see if there's any safety features. We've seen things like chipping paint, missing railings, things of that nature that the appraiser will mark and flag, and the home seller has to fix those. When we get to home inspections, that's negotiable for repairs. Appraisals, that's not a negotiable. They have to take care of that.
And don't get it twisted where somebody says, we need to go conventional because the appraisal will likely miss the stuff.
It comes
There
up.
was somebody that I was talking to recently that is a colleague of mine, and there was a literal hole in the roof. And they thought because it was conventional financing, not my colleague, but the realtor, thought because it was conventional that they could overlook it. There was a hole in the roof. That is a huge safety concern, and yes, it's going to have to be fixed. They're considering doing some sort of roof escrow or trying to figure it out. But from a macro level, the question always is, how good of a shape does a property need to be in for standard financing? It's safety hazards or no safety hazards. If there are safety hazards, they need to be fixed.
Yep. And then, that's absolutely correct. That's a non-negotiable, really.
Mm-hmm.
And then once the appraisal comes in, the other question I always get is, what if it comes in low? If it comes in low, then you're back to the bargaining table, right? Usually sellers start with if there's any closing help, right? If there's closing help, usually they kind of negotiate that down a little bit to kind of get a little more money in their pocket. Mm-hmm. If that doesn't work, they try to ask the buyer to pony up a little bit more money, which is also why the 20% conventional loan is more appealing, because they usually have more money in their pocket. Mm-hmm. And so you can put a little more down.
Yeah.
But if that's not the case, if you're USDA, then at some point the seller has to come down in price. And that's usually the third step. Not always like that, but it's usually that's the way. So after the appraisal happens, the inspection's done. If repairs have to be made, has to be done by a licensed contractor. The homeowner can't do repairs. They can't have their brother-in-law do the repairs. Has to be a licensed contractor with receipts. So if something down the road happens, you've got that contractor's contact. Mm-hmm. So after the repairs have been done, appraisal is done, inspection's done, then honestly it's just Tim and I doing behind the scenes. We have our title company who pulls the deed to make sure that there's no breakage in ownership, if there aren't any liens on the home, if they haven't been paying their taxes or anything of that nature, that has to be paid at the table. As a home buyer, you will not be taking on any of those issues or debts or liens. That's what our title company does.
Yes, and if somebody asks you about title insurance,
do it.
Protects you from all that stuff.
Do it. Yeah, so if title insurance essentially, if there's a breakage in lineage in, let's say, 1980, and the person's like stepbrother shows up to your house and says, hey, listen, this house is mine, your title insurance protects you against any possible previous owners or any problems.
It's a one-time fee, and it covers you for as long as you own the property. So sometimes people try to save $800, but again, just like any other insurance, you'd rather have it, not need it, than need it, not have it.
I do have a listing coming up, and the homeowner noticed that it wasn't. I didn't help him buy the house. It was years ago, but that the title company never actually submitted the paperwork to have his name put on anything. So when you go to tax records, it's the previous owner's name on it still. And luckily, he had title insurance, but had to go back to the title company, who was out of business, but it was bought out by another title company who had to rectify the situation, and he had to fix it so that way his name's now legally owner.
Goodness.
It happens.
Wow.
Rare, but if it happens to you, yeah, it's worth a couple bucks.
Yeah,
surely. Is.
Sure. Yeah, the title company has they're like the unsung heroes because they're in the background for most of the transaction, but every now and then something will emerge, and you'll go, goodness gracious, thank God they exist, because we could have, it could have been bad.
Could have been bad.
And then they're the ones that sit at the table and sign all the legal documents with you.
Yeah, and Allison does a great job.
Allison's great. Love Allison.
And then once you get to the table, usually do a walkthrough up to 3 days before closing. Make sure everything works. Make sure all the repairs are done. Usually I'll try to do it the day of, because I hear all those horror stories about like frozen pipes and the house filled up with water. And so I'm always like really nervous about that kind of stuff.
Yeah.
So we try to do it like day of, but you can do it up to 3 days in advance. And then you do your walkthrough, make sure everything's there, good to go. After that happens, you sit down with us, sign the papers, get the keys, and it's yours.
Yeah, and that relationship continues after closing, because things are going to pop up. You're
always
you have a question about your loan. You every fall you get an escrow analysis, and you find that your property taxes have gone up, and there's questions about your payment and things of that sort. I'm a lender for life. I don't know what your tagline is, but I'm always there to help you go through these issues. I have clients that reach out 3-4 years after they close and say, hey, I got this mail and something's going on, and I'm always diving in to help. So that's the relationship that we create that you don't get from these big entities that don't really care about your well-being. They truly don't.
We'll remain nameless. We won't go that route. But
we won't. Offline.
Usually my tagline is, I got a guy. People call me all the time. Hey, I got a paint. Do you have a guy? Yes, I do. Hey, we're thinking about solar panels. You got a guy? Yeah, I do. Hey, you want a security system? Got a guy? Yeah, I got a guy for that. I have a guy for whatever it is you're looking for.
Or girl.
Or girl.
Yeah.
It's a phrase. It's just a generic phrase. I got a person. See, I got a person doesn't sound quite as good, though.
No, it doesn't.
I got a guy.
Got a guy. The alliteration. I love it.
I got a guy. So, yeah, if you're ever, that's where I'm usually in. And I have clients that call me all the time or text or whatever. I'm looking for this, or what do you think about this? Or even coming over. Like if you're taking on a big project, we have a client who's thinking about listing right now, and there was a pretty big project with the bathroom, and they weren't sure which direction to go, so I pulled up some comparables, see what's going on in the neighborhood, and gave that to them before they took on the bathroom remodel. But I think they ended up doing like some plumber, some themselves, based on the numbers we gave them.
Yeah.
Because I was like, hey, it wouldn't make sense for you to hire somebody to do all of it. It's just the numbers aren't there. But if you take on certain parts of it, like the cosmetic, like the sink and the paint, knock off some of the price, it makes sense for you.
I think that's a good point to make, where if you're somebody that's looking to sell a house and buy another one,
let's do that.
Waiting until the moment that you're ready to list to reach out to Billy is probably too late. I think the early on conversation where you can come over and say, hey, all right, let me look at this house, let's see what you've done since the last time I've helped you.
Yep.
And the question sometimes becomes, is it worth it to do this project or that project? And Billy can give his honest assessment, where I don't think you're going to get the return on that.
Yeah.
Should I paint? Okay, how bad is it? Because the next person's going to paint anyway. There's a lot of nuance to it, so getting Billy in the house early is important.
Well, even the level of materials, right? Too, you walk into a house and they want to do like flooring. Like, what kind of flooring should I put in here? Should I do hardwood? Should I do this? I'm like, all right, this is what's going on in your neighborhood, and because we flip houses and do all the renovations, like, hey, they come out with this kind of product. You should go with this engineered hardwood because it looks very similar, but that's what your neighbors are doing. Even though I know you love hardwood, maybe the next house do hardwood.
Yeah.
So even the level of the quality, like, I very rarely tell people to do cheap stuff, but like middle grade, high grade, or, your uncle should do this. Or I look at a project and I'm like, you could definitely do this if you really wanted to. That, like, that vinyl flooring, those planks. Sure, man, you could do that. Put that on your basement. I know you're younger. You got some energy to do it. Those kind of conversations happen pretty frequently.
Or if you're in a hurry to make that move, what we found recently or historically is in lieu of doing home inspection items or you give a credit to the buyer. I know that we did that with our house. House that we sold in 2020. we did the middle grade flooring in the basement just to get it freshened up. And then the buyer came and said, "Hey, these few little things we'd like you to do." And we said, "What's $3,000 sound like?" And we gave it, and we issued a credit and paid towards their closing costs, and that made them happy. So sometimes you do enough to get the house on the market, and then the rest will fall into place later.
Yeah, you're really negotiating in stages.
Yeah.
Up front, once repairs are done, once the appraisal's done. So you're doing, there's various stages of negotiation throughout the process, and we can help guide you through that, of course, and tell you when it's appropriate.
Yeah. So sticking on the I need to sell to buy another house conversation.
I think that might be in the questions, though, isn't it? Yeah, I think it is. Want to do questions?
Okay,
I think it
it
is.
Yep.
So the quickest review, we'll review the process. So Tim went over his lending part, and he goes over the types of loans. Our part, as a quick recap, you come contact us, either Tim or I, doesn't matter who's first. He'll either run numbers and get you set up for pre-approval, or if you come to me first, we'll walk through a house and kind of get an idea of what you're looking at, and then I'll send you the Tim. After that, once you know what the numbers look like for you, we get you set up with a search that learns your tendencies and so forth, and it's a really solid search. You find houses you like, we set up showings, we walk through, you're looking at certain things, I'm looking at certain things as we go through the homes. Once that happens, you find the house you like, we do paperwork together, I explain it, we walk through it, we put in some fall safes and things to protect you as a consumer. After that part's done, we do the inspections after it's accepted. After the inspections are done, you negotiate one more time. After that happens, we get the appraisal to make sure the numbers all work out. From there, you do your walkthrough near the very end, and then after that, you sit down with the title company and take the keys and enjoy your new home. That's the recap. So if you're taking notes, it won't be able to put on slow motion or rewind, but that's it. That's your notes. We went over it a few times. But anyway, there you go. So our questions. So do we have any questions quite yet? Nope. No, we're good so far with questions. We must be doing a good job of going over these things.
I think we're staying out ahead of it.
So the questions we had from the folks that were going to attend in person. Number one, what is the first step in the home buying process? Well, that one's easy because you and I kind of went over that. Either Tim or I talked to one of us first.
Yeah, just reach out. I mean, there is such a variety of ways to contact us.
Yeah, and you know what? I'll say this too. Tim may not, but if you decide you want to go to a big box store and you get numbers from them, at least come back and talk to Tim about what you get, because they won't get that personal touch often. You'll get somebody in like Iowa or somebody wherever giving you a big numbers, but then take it and say, listen, this is what he gave me, Tim. What can you do? And at least give that conversation started up, right? If you decide to go that route.
Yeah, because our goal is to give you the best services at the best price. Yeah. So if you think you've gotten the best price, bring it to me, and I will try to give you the best service as well.
Yeah, that's it. Once you found a home, then what? What are some of the expenses? So we went through the process, but I'll tell you expenses, inspections, right? So that's one that people, and that price varies, so I don't want to get too in the weeds because I know some inspectors charge different amounts, but I think in ballpark numbers, they do the structural mechanical per square foot, but you're looking at, $600 to $800 depending on how big the house is. You do the water test, it's about $150, give or take. It can vary depending on how far away the house is from the water center because they have to collect the sample and actually take it to the treatment center. Septics, usually $500 to $600 because that's very time consuming. Be sure that they have at least a camera or something where they're seeing the drain fields as well as the septic system itself. What else? Radon. Radon's not too bad. I think it's 100 something. What they do is they put a little canister down there. They leave it there overnight and come get it the next day and see if you have any radon. Which one am I missing?
Termite. If you need termite.
Termite's not too bad. 75 to 100-ish.
Yeah.
They go through, make sure everything's good.
Yep.
And you'll get a termite report.
WDI. So you does it range 1,200 to 1,500 if you get everything?
Yeah, give or take.
Yeah.
And again, it depends on the size of the house, and it depends on certain inspectors. Some maybe a little more if they're more thorough, and some maybe a little more cost effective. But in general, if you're thinking those numbers, you're going to be about that ballpark.
Okay, so that's home inspections.
Appraisal,
anywhere depending on your loan program between $575 and $675. Let's just call it. That's an upfront cost that you're going to pay for prior to the appraisal taking place. And your earnest money deposit. We tend to use the acronym EMD. Earnest money deposit is you putting a bargaining chip in front of the seller to say, if I walk away from this property for no other reason other than cold feet, this is the amount that you then to procure for taking this house off the market and wasting your time. The bigger the earnest money deposit, the bigger bargaining chips. So sometimes as a, you're in a multiple offer situation, a lot of clients are kind of battling back and forth. Somebody will put forth a big deposit, sometimes 20 grand. I mean, in some of these markets, EMDs are sometimes $50,000. But down here, if it's a
couple grand.
Yeah, a couple grand. If it's a big house, $600,000-$700,000 house, it's not uncommon for me to see 15 or 20 grand because people go, this is the house. I know I'm not getting cold feet, so let's just put it forth. There's still ways to get it back. If a financing contingency, if something falls through with your loan, or if there's some protections in the contract, sometimes you get it back. But that cold feet piece, so that's an upfront cost, but it gets credited towards your bottom line. So let's go back to my example: $20,000 down payment on that $400,000. If you put a $5,000 deposit down, your down payment's $20,000. You're now bringing 15 of it to closing because you've already written a check for $5. So whatever it is, it gets credited towards your bottom line.
Yep. I think in 16 years, I've had 3 on my team. Even I've had 2. I had a team member get 1. 2 of them, they got cold feet the day of. 1 person actually fled the state.
Oh my gosh!
To get cold feet. Another one, the dad came and saw it and talked her out of it the day of. And 1. The person, it's still in limbo actually. So 3 ever in 16 years. So it doesn't happen often.
Yeah.
But
I had one that almost walked away, and he was willing to give away his deposit because he found out that it was going to be very difficult for him to get internet at the house, and he works remotely. So it was kind of a non-starter for him.
Oh, that's interesting.
But he got like the very worst quote up front. It was going to cost only 20 grand. But then once they inspected, they realized it was going to be a lot cheaper, and he moved forward with it. But he was like, look, it's worth $3,000 for me to walk away from this because literally my livelihood is the internet in my house.
Yeah, that makes sense.
Yeah.
So rare cases, but it happens. If I have a home to sell first, what are my options? So we're talking to the people that are looking to buy that only did it a few years and they have a house they have to sell. So those home buyers, like you said earlier, we don't want to neglect them. There's always 3 options I chat about. One is the toughest, but also the easiest in this competitive market is sell the house first, find some temporary living, maybe a rental or, dare I say, family member's house, which is always a tough one. Mm-hmm. That way you're not contingent, which leads us to the second one, which is you make contingent offers, right? So I want to buy this house, but it's contingent on me selling the house. But if there's multiple other offers that are involved, that seller would be less likely to take your offer. Mm-hmm. You can also put your house on the market with seller's right to sell, right? So you have a period where you put it on the market, you get the offer, you accept it, and then you have whatever, 60, it's negotiable, 90, whatever amount of days to find your next house. And then the one that I always kind of screw up a little bit because I'm not as educated, but the bridge loan option. I'm going to leave that to you because I don't do a great job with that.
There are some financing pieces that can help with this transition. The bridge loan, or as first time it's called the equity booster, it allows you to use the equity in your property, leverage it to put towards that next house without a contingency. Okay, so let's give an example. Let's say you have a house to sell, it's worth $500,000. You owe $200,000. You can take a portion of that delta, borrow it from First Home, put it towards the new house. The only clause is that that house must be on the market at least one day, and it needs to sell within 12 months to pay off that bridge loan within 12 months. So you're saying, I know this house is going to sell. It's a perfectly good house. I have a ton of equity in it. I just don't want to be contingent. So do a bridge loan. It then takes that equity, puts it into the new house. It's just another loan to pay off once that other house sells. But now that equity is now rolled over into the new home. So yes, a bridge loan is a great option. Some people pursue a home equity line of credit on their house.
Oh, yeah, that's right.
It's a perfectly viable option. You just kind of have to start that process earlier because HELOCs take a little while to close.
Yeah.
Perfectly viable option. You take a HELOC for $150, you don't have to draw on it right away. Take a HELOC for $150, you put it towards that new house once you go under contract, you draw $150 on it, and then it pays off as soon as you sell the other one. So again, that's not a contingent offer, so it's a little stronger. Like you said, the best way, most competitive way is to just go ahead and get your house sold because then the money's there.
You get everything.
You have flexibility. It is the most difficult though.
It is, and Tim has room in his basement, so if you wanted to rent out space in his house, like you could always just do that too.
My wife's not watching this, so sure. Yeah.
So there you go. There's some options, right? So there you go. Number 3. Good. 4. What does a monthly mortgage for like $400,000 look like? Which is how we started.
Yeah, we used that example because we got the question.
It was a great question, so I figured that would be very pertinent and very helpful to everybody to visualize.
Yeah.
How do I avoid PMI? We did that, putting 20% down, and or the value of your house going up. And here's the other part too. I had a lot of people reach out. Well, actually, first, let me take a step back. Once you buy that house, we set you up to get information about the value of your house. It comes to you weekly. It's a great program. It tracks everything, and it's accurate. It's not Zestimates or Zillow, whatever that stupid thing Zillow does, which is insane. It actually pulls from the MLS and gives you the real, actual values of your house.
Yeah.
And if that gets like close, you're like, man, I'm close to that 20%. Reach out. I'll run you a new net sheet or new comparable that you can actually provide to Tim and say, listen, Billy ran the comps. Here's what they look like. What do you think? And you can give them an assessment of whether that can get rid of it or not.
So here's another thing to think about. Okay. I'm not going to whiteboard it. Let's just talk about it. So I said earlier, what if 7% goes to 5%? Interest rates.
Yeah.
If there's an opportunity later on down the line, a year and a half from there, where say, hey, rates have improved by 1.5% since you bought.
There you go.
Let's refinance. At that point, I'm going to also evaluate your loan to value position, and I might say, hey, we have the opportunity to not only lower your rate, but we can get that PMI
out of the way. That's a twofer.
It's a twofer, and you just kind of do it with the refi transaction rather than you applying to have the PMI removed, which is a little bit more difficult because you don't have a Tim Sisson to help facilitate that. But when you do the refi, you can kind of do both. That's one of the value propositions of a refi is, hey, I'm going to lower your rate by 1.5%, and I'm going to get rid of that $70 a month PMI payment. So now you're net to the good hundreds of dollars per month.
That's good stuff.
Yeah.
And then last one, are there any hidden expenses that a first-time buyer is not aware of or does not think about? I would think probably home inspection is the biggest one. We went over some of the values. You went over the appraisal. Aside from that, I don't think there's any hidden ones. If there's HOAs, it's disclosed. If there's a water bill or a gas bill, those are always disclosed.
Hidden, I don't want to have this fall under hidden, but I do want to caution buyers that because this is a competitive market, you're much better prepared to buy a house if you can pay your own closing costs. So knowing what the closing costs are is very important. And I will say, not to prop us up anymore, but we are up front saying, hey, you need to expect this amount at closing for closing costs. Whereas if you go to the big box store mortgage company, they spit out a pre-approval letter, and you know what they say? We don't run numbers until you're under contract.
Yeah.
That is so backwards. That is cart before the horse, because in order for you to want to put an offer on that house, you got to know what it's going to cost.
You should know.
So there's one that's big, and everybody knows them, and they use a lot, and the fact that they refuse to run numbers before somebody's under contract is just baffles me. So. Not that that's a hidden cost. It's not a hidden cost.
Yeah.
But it is a cost you need to be aware of, and how much is it going to cost you. And it is sort of tiered towards sales price. The higher the price of the house, the more the closing costs are going to be, because transfer taxes and origination points and things like that are a percentage of the loan amount or percentage of the sales price, and then some fees are fixed. So you just got to know what they are. That's all it is. We send it to you. We go over it. You come to the office, and I literally flip my screen around, and I kind of say, this is where your closing costs are going to be. So be aware of that.
There you go.
Don't let it be hidden. That's the point. Okay, it's not a hidden unless you use a company that hides it. There you go.
There you go. So there you go. That's all the information you need if you're a first-time or even second-time buyer. Second-time buyer is a little easier in the sense that you've gone through at least once, so it's more of a repetition, like, oh yeah, I remember that, and I remember this. Mm-hmm. And then we do have the video series. Reach out. I give it to everybody for free. And we always sit down and chat about it. If you're even thinking about it, just set up a time to sit down with Tim and look it over.
I love being a local lender, especially in the location I'm in, where people can stop by and pop in. We're right here, southbound side of Route 4 in Dunkirk, so if you're somebody that works in D.C. and lives in Prince Frederick, you've got to pass by anyways. So I love our location for that reason. I'm all about the in-person meetings. Let's do it.
Plus, he'll give you a liquid death.
Yes. murder your thirst.
And of course, be on the lookout because we are always out doing community events. We have one coming up here soon, but jump on our social media. You'll see them all over the place. We do a lot of teacher events, police, firefighters. We do community events constantly. We're always helping local businesses. That's my mantra, is to help the community that which I live in. Just selling houses is not enough. I want to also build up and support the community in which I'm selling those houses, because I want to be proud of where we're at. So
Sure.
be on the lookout of all those
Agreed.
things. Tim's with them a lot. And then most of the time there's some food and beer involved. So yeah, there's a lot of that going on too.
We'll do that again.
Can't argue with that. So
Thank
all
you
right,
for
sir.
tuning in.
Yeah, let's see if
This
there's
was
any,
really fun.
any other questions. There is. Other incentives offered by the First Home Mortgage. Are there incentives?
Okay, so that's a good question. We do have, we have such a variety of programs these days. I will say that almost all of them are income-based.
Okay.
So there's been a big push, not only from my company, but from the Federal Housing Agency to incentivize home buyers that are 80% AMI or lower. What's AMI? Adjusted median income. So 80% or lower, there are incentives like $3,000 grants. There's better pricing for interest rate. There's better pricing for PMI. And then there's the next level incentive would be Maryland Mortgage Program, USDA. They're all income based. Okay, they're not all. Some of them are first time home buyer based, right? So it's income and are you a first time home buyer? But people always say, "Hey, I'm pursuing a first time home buyer loan." It's really not that. It's really how much money do you make. So you're kind of trying to hit this target of, I need to make enough to qualify for the loan, but I don't want to make too much to miss out on some of the incentives. We do have a First Home Heroes program, which incentivizes community partners, teachers, nurses, police officers, firefighters. That allows you to eliminate the lender fees. So we do have First Home Heroes. We have a variety of down payment assistance programs. But again, most of them are income-based. There's one down payment assistance program that is not income-based.
Okay.
So to answer your question, yes, there are a lot of incentives. There's actually too many for me to remember off the top of my head that I would, again, just come to the office and we'll talk about it.
Okay. Cool. Let me see if we had any other one. Liquid death water rocks.
It's the best.
More of a comment than
Mountain water.
Yeah. And then actually we could give a shout out because one of those comments and questions came from one of the best food trucks in all of Calvert County. There, Miss Heidi. If you haven't had Heidi's Eats, like you got to follow her because
So
it's
delicious.
so good.
I know. I love it.
She's actually been to a few of our teacher events. Yeah, it's been a long time. So yeah. Thank you everybody for following along. If you have more questions, it's easy to find us. We're on social media, Facebook, Instagram. My number, 410-708-8858. And email is just sammonsrealtor@gmail.com.
Cell number 443-624-0235. Loanswithtim.com. tsisson@firsthome.com.
There you go. We're easy to find. We're out and about. So if you have any questions or comments and concerns, let us know. Thanks for tuning in. And let us know. We'll do some feedback to see if you enjoyed this format or if you wanted to start getting back into in-person. So we made the adjustment based on our feedback, and we'll see how it goes.
Yeah. Bye, Heidi. See ya.